Hello and welcome, everyone, to Chapter 9 of FIN552, Investment and Portfolio Analysis. In the last chapter, we looked at how professionals manage a whole portfolio of shares. Today, we get much more practical and personal because we look at two investment products that ordinary Malaysians actually buy, mutual funds and warrants. A mutual fund, which you may also know as a unit trust, is simply a way for many small investors to pool their money together so that a professional can invest it in a big diversified basket of shares on their behalf. A warrant is something quite different and more adventurous. It is a cheap geared reservation that gives you the right to buy a share at a fixed price in the future. By the end of this chapter, you will understand both products, you will know their advantages and their dangers, and most importantly, you will be able to perform the 6 key calculations that the exam will test, including working out the price of a fund unit and the value of a warrant. As always, I will define every term the first time it appears and assume you are meeting these ideas for the first time. Let us begin with a simple question. Let me open with a question that sits at the heart of this chapter. Imagine you have 10,000 ringgit to invest. Would you try to beat the market, hoping to earn more than the average, or would you simply try to match the market as cheaply as possible? And here is a second, more daring question. Could you turn just 1,000 ringgit into 5,000 ringgit worth of exposure to a share? Believe it or not, the answer to both is yes, and the 4 big ideas on the screen explain how. The first idea is the mutual fund, where you pool your money with thousands of other people into one professionally managed, diversified portfolio. The second idea is the choice between active and passive management, the two rival philosophies of trying to beat the market versus simply matching it at the lowest cost. The third idea is net asset value, or NAV, which is how the price of a single fund unit is worked out, together with the full menu of fund types you can choose from. And the fourth idea is the warrant, a cheap and geared reservation that lets you control a share for a fraction of its price, with high risk but high potential reward. Keep these 4 cards in mind, because they are the map of our entire journey. Before we dive in, let us see who actually uses these products in the real world. Before you dismiss any of this as dry theory, let me show you how real and how enormous it is. The same 2 ideas you learned today, pooling money and valuing instruments, move trillions of ringgit here in Malaysia and around the world. Look at the first column, the Malaysian giants. ASNB and its parent PNB run the famous ASB and ASN funds that millions of Malaysians hold. The EPF, our retirement fund, and Tabung Haji, which pools savings for pilgrims, both invest large sums through managed funds. QAP is the pension fund for government servants. In the middle column are the local fund and warrant houses. Firms like Kenanga and Afin Huang are active unit trust managers who pick Bursa shares. Bursa Malaysia itself is the exchange where structured warrants are listed and traded, and big institutions like Macquarie and CIMB are the issuers who create those call and put warrants. In the third column are the global asset giants. Vanguard invented the cheap passive index fund. BlackRock, through its iShares brand, is the largest manager in the world and the leader in ETFs, and Fidelity and PIMCO are active investing powerhouses. The key lesson in the gold box is that every single one of these institutions is doing the same 2 jobs you are about to learn: pooling money to diversify and valuing instruments correctly. Now let us set out exactly what you will be able to do by the end of this chapter. Let me tell you exactly where we are heading, because knowing the destination makes the journey easier. We have 5 learning outcomes. and each carries a Bloom's taxonomy code from C1 to C5, showing how deeply you must master it. The first outcome, a remember level C1, is simply to define the key terms, a mutual fund, NAV, a warrant, and the main features of each. The second, an understand level C2, is to explain the big concepts, pool diversification, the difference between active and passive management, and the difference between open and closed-end funds. The third outcome is the most important for the exam, an apply level C3, where you compute the numbers, NAV per unit, redemption value, the intrinsic value of a warrant, the warrant premium, the gearing, and the conversion premium. The fourth, an analyze level C4, asks you to compare different fund types and to decide when a warrant should actually be exercised. And the fifth, an evaluate level C5, asks you to weigh the advantages and the risks of these products for a real Malaysian investor. Notice the exam tip in the gold box. The heart of the calculations is LO3, with 6 separate sums to master. I will walk you through every one. Now let me show you the roadmap for the whole chapter. Here is the map for our whole journey. 10 clear stops in 2 halves. The first 6 stops are all about mutual funds. Stop 1 is the fund concept, how pooling works. Stop 2 is the choice between active and passive management. Stop 3 weighs the honest pros and cons of funds. Stop 4 looks at how a fund is structured and who runs it. Stop 5 is our first set of calculations, the net asset value maths. And stop 6 surveys the full menu of fund types and the sales charges called loads. The remaining 4 stops cover warrants. Stop 7 introduces what a warrant actually is. Stop 8 teaches the vocabulary, the features of a warrant. Stop 9 weighs the pros and cons from both the investors and the company's point of view. And stop 10 is the big one, valuing a warrant with 4 formulas and full worked sums. Notice the underlying logic shown in the takeaway. The 2 halves share one theme. You either pool your money and diversify through a fund, or you take a cheap geared bet through a warrant and learn to value it. Let us begin at stop 1, the mutual fund concept. Welcome to section 1, the mutual fund concept. Before we can value anything or weigh any pros and cons, we must understand the simple but powerful idea at the center of this whole product, pooling. The basic insight is that a single small investor cannot diversify, but thousands of small investors together can. In this section, we will define exactly what a mutual fund is, and then see step by step how pooling many people's money turns a crowd of tiny, vulnerable investors into one large, well-protected portfolio. Let us start with the definition. So, what exactly is a mutual fund? You may also hear it called a unit trust, which is the more common name in Malaysia, or an investment company. The plain language idea is in the blue box at the top. Many people put their money into one big pot, and a professional uses that pot to buy lots of different shares so that everyone shares the gains and spreads the risk together. Now let me give you the formal definition you can write in an exam. A mutual fund is a financial services organization that receives money from a group of investors and uses it to buy a diversified portfolio of securities. And in return, the investors receive units that make them part owners of that portfolio. 3 features define it, shown in the cards. First, pooled diversification. It combines money from many people with similar goals into one pot that buys many different shares. So the risk is spread, the old wisdom of not putting all your eggs in one basket. Second, you own units, not the shares themselves. Each unit is a slice of the whole pot, entitling you to your share of every gain, every dividend, And yes, every loss. And the price of one unit is called the net asset value, or NAV, which we will calculate in section 5. Third, it is professionally managed. A management company of full-time experts builds and runs the portfolio. And for this service, you pay a small annual fee. The takeaway captures it perfectly. A mutual fund equals pooled money plus a diversified portfolio plus professional management, and remember, you own units, not the underlying shares directly. Let us now see exactly how this pooling protects you, step by step. Let me show you exactly how pooling makes each individual investor safer, because this is the whole magic of a mutual fund. Follow the 4 steps across the top. Step 1. Investors pool money. Thousands of small investors, each perhaps putting in as little as 100 ringgit, pay into one common fund. Step 2. The manager builds the portfolio. The management company takes that large combined pot and buys a wide variety of shares across many different industries: banking, technology, plantations, and so on. Step 3. The risk is spread. Because the money is now in many different companies, if one company performs badly, the others cushion the blow. The loss is diluted across the whole portfolio rather than wiping you out. Step 4. The returns are shared by units. Every gain, every dividend, and every loss is split fairly among all the unit holders, in proportion to how many units they own. Now look at the why it matters box, because it makes the benefit concrete. With 100 ringgit on your own, you could buy maybe 1 or 2 shares, leaving you completely undiversified and exposed. But pulled together with 10,000 other people into a fund of 1 million ringgit, that same 100 ringgit now owns a tiny sliver of 50 or more companies. That is instant diversification that no small investor could ever achieve alone. The takeaway sums it up. Pooling converts many tiny, undiversified investors into one large, well-diversified portfolio, with the risk shared, the cost shared, and the expertise shared. Now that we understand the concept, we must ask how the manager invests the pooled money, and that brings us to the great debate of active versus passive management. Section 2 takes us to a choice that every fund must make, and that you met briefly in the last chapter: the choice between active and passive management. Once a manager has pooled all that money, how should they invest it? Should they work hard and charge more, trying to beat the market, or should they sit back, charge almost nothing, and simply track an index? This is one of the most important and most debated questions in all of finance, and the answer affects how much you pay and how much you keep. Let us lay the two philosophies side by side. Here is the core trade-off of fund investing, laid out side by side. Do you pay for skill, or do you pay almost nothing to simply track an index? On the left is active management, and notice the red tag, higher cost. The active manager's goal is to beat a benchmark and earn extra return above the market. To do this, they use fundamental analysis, studying companies' financial health, and technical analysis, studying price patterns. Their core rule is to buy a security whenever its intrinsic value, what they calculate it is really worth, is greater than its market price, the price you can buy it for today. In short, they hunt for bargains. But all this research and trading costs money. So active funds charge higher fees. You are paying for the expertise. On the right is passive management, with the green tag, lower cost. The passive manager has a completely different and humbler goal, simply to track an index as closely as possible. Their portfolio deliberately mimics a benchmark, such as the FBM KLCI, our main Malaysian index. They make no attempt to outperform, they just match. And because there is very little trading and almost no research, their fees are very low. In the gold circle in the middle sits the word versus, because these two philosophies genuinely compete. The takeaway: active means trying to beat the market with higher fees and higher hope, while passive means matching the market cheaply. And remember one piece of vocabulary: a benchmark is simply the index you measure your performance against. Now, the natural question is, does all that extra effort and cost of active management actually pay off? Let us look honestly at the evidence. So, does paying for active management actually pay off? Let me first show you the rule an active manager follows, and then give you the honest verdict. The decision rule is in the box on the left, and it has three simple lines. The first line: if the intrinsic value is greater than the market price, then buy the security because it is underpriced, a bargain. The second line: if the intrinsic value is less than the market price, then sell it or avoid it because it is overpriced. So the whole game of active management is buying things worth more than their price and avoiding things worth less. The third line is how we judge success. If the manager beats the benchmark after fees, then they have added what we call alpha. Alpha, written underneath, is the extra return above the benchmark. Think of it as the bonus marks a manager earns for genuine skill. Now, to the honest verdict, in the gold box on the right, and this is important, after fees, most active funds actually fail to beat their benchmark. Think carefully about why. The high fee is a guaranteed cost you pay every year no matter what. But the outperformance, the alpha, is only a hope that may or may not arrive. So on average, the certain cost of fees drags most active funds below the cheap passive index they were trying to beat. This is the single strongest argument for low-cost passive investing. The takeaway: after fees, most active funds fail to beat their benchmark, and alpha is the name for the extra return a skillful manager adds above the index. Having weighed active against passive, let us now weigh the mutual fund itself, its real benefits, and its real drawbacks. Section 3 is short but important, and it is about balance. No investment is perfect, and a good investor weighs both sides before committing. So in this section, we put the mutual fund on honest trial, listing its genuine attractions on one side and its real drawbacks on the other. By the end, you will be able to advise someone fairly, neither overselling funds nor dismissing them. Let us look at both sides. Let us put the mutual fund on honest trial and weigh both sides, because every benefit comes with a cost. On the left, in the gold-headed card, are the attractions, the real advantages. First and most important is diversification. Your risk is spread over many companies and many industries, so no single failure can ruin you. Second is professional management. Full-time experts research and run the portfolio for you, which most of us have neither the time nor the skill to do. Third is convenience. Funds are easy to buy. Their prices are widely quoted in the newspapers and online, and you can invest with a few clicks. And fourth is modest capital. You can start with a small amount, sometimes as little as 100 ringgit, and still get full diversification. Now to the right, the drawbacks, the honest disadvantages. First, poor performance is always possible. Returns are never guaranteed. A fund can and does lose money. Second, charges and hidden fees quietly eat into your return year after year. And we will meet some of these fees, called loads, shortly. Third, you lose control. It is the manager who decides which shares to buy and sell, not you. So if you disagree with their choices, your only option is to leave. And fourth, there is a trading limit. An ordinary open-end fund is priced and traded only once a day at its NAV, so you cannot react instantly to news the way you can with a share. The takeaway balances it. Funds give you diversification, expertise, and convenience for very little money, but in exchange, they charge fees, offer no guarantee, and take the control out of your hands. Next, let us look inside a fund to see who actually runs it. Section 4 lifts the lid on a mutual fund to show you the machinery inside. When you hand over your money, who actually looks after it, and what stops anyone from simply running off with it? The answer is a clever division of labor among 4 separate players, designed so that no single party ever controls your money completely. After meeting the players, we will learn a crucial structural distinction that affects how units are priced and traded, the difference between open-end and closed-end funds. Let us meet the players. When you invest in a mutual fund, your money is looked after by 4 specialized players, and the whole arrangement is deliberately designed so that no single party ever controls your money on its own. This separation is your protection. Let us meet them. The first is the management company, also called the investment advisor. This is the brains of the operation, the firm that builds and manages the portfolio and makes all the buy and sell decisions, the one whose name is usually on the fund. The second player is the custodian, and this one is crucial for your safety. The custodian is an independent party, separate from the manager, whose job is to physically safeguard the fund's cash and securities. Notice the clever design here. The firm that decides which shares to buy, the manager, never actually holds your cash. That is held by the independent custodian, which makes fraud far harder. The third player is the transfer agent, the record keeper. The transfer agent keeps the register of all the unit holders and processes every purchase, every redemption, and keeps the record straight, so you always know exactly how many units you own. And the fourth player is the distributor, the sales force. The distributor sells the fund's units to investors through banks, through agents, and increasingly through online platforms. The takeaway explains why this matters. By splitting the roles among manager, custodian, transfer agent, and distributor, the structure protects investors because the firm that picks the shares never directly holds your cash. Now, let us learn a structural difference that changes how a fund's units are priced and traded, open-end versus closed-end. Now, a structural difference that sounds technical but is genuinely important, the difference between open-end and closed-end funds, because it decides how units are created, priced, and traded. On the left are open-end funds, which are by far the most common type, and the ones we usually mean when we say unit trust. The defining feature is that there is no limit on the number of units. The fund is open. When new investors put money in, the fund simply creates new units for them. And when investors leave, those units are cancelled. So the fund expands and contracts like a balloon. You buy and sell your units at the NAV, the net asset value, calculated at the end of each trading day, and you are free to withdraw your money any day you like. On the right are closed-end funds, which behave very differently. Here, the number of units is fixed, set once at launch, and the fund does not issue new units afterwards. It is closed. So how do you buy in if no new units are created? You buy existing units from another investor on a stock exchange, exactly like trading a normal share. And here is the subtle consequence, because the price is set by supply and demand on the exchange. A closed-end fund's market price can differ from its NAV, trading either above it, called a premium, or below it, called a discount. The takeaway captures the contrast. Open-end funds expand and contract and are always priced at their NAV, while closed-end funds have fixed units that trade on the market at a price which can sit above or below NAV. Now we reach our first real calculation of the chapter, the net asset value itself. Section 5 is where the mathematics begins, and I promise to make it gentle. We have said several times that the price of one fund unit is called the net asset value, or NAV. Now we will actually calculate it. The idea behind NAV is beautifully simple and intuitive. It is just the fair share of the fund that belongs to one unit. In this section, I will give you the formula, walk through a quick example, and then take you through two full exam-style worked examples, one for the basic NAV and one for a redemption after a dividend distribution. Grab a pen, because this is a do-it-yourself topic. Here is the net asset value, the fair price of one single unit of the fund, and the way to calculate it. The plain language recipe is in the blue box. Add up everything the fund owns, subtract everything it owes, and then divide by the number of units. And that gives you the value of one unit. Now the formula on the left. NAV per unit equals, in the numerator, assets plus other investments minus liabilities, all divided by, in the denominator, the units in circulation. Let me define each term, shown in the navy box on the right. Assets means the market value of all the securities the fund holds, the shares and bonds. Other investments means cash and any other investments sitting in the fund. Liabilities means everything the fund owes, such as unpaid fees or loans. And units means the total number of units currently in circulation, owned by all the investors. So in words, you take the total value of what the fund owns, subtract its debts to get the net value, and share that net value equally among all the units. Look at the quick example at the bottom to see how easy it is. If a fund has 10 million ringgit in assets, no liabilities, and 500,000 units, then the NAV is 10 million divided by 500,000, which equals 20 ringgit per unit. The takeaway is the formula itself. NAV per unit equals assets plus other investments minus liabilities, all divided by units. Now let us do a proper exam-style work example with bigger numbers and a liability to subtract. Now our first full exam-style work example, and I want you to follow every single line so you could reproduce it with no help at all. The question in the gold box concerns the Amanah Bistari Unit Trust. It has total assets of 450 million ringgit, liabilities of 280 million ringgit, and other investments of 30 million ringgit. There are 140 million units in circulation. We are asked to calculate the NAV per unit. Step 1, batch number 1, put the values straight into the formula. The numerator is assets plus other investments minus liabilities, so that is 450 million plus 30 million minus 280 million. The denominator is the units, 140 million. Be careful with the order here. A very common mistake is to forget to add the other investments or to forget to subtract the liabilities, so include all three. Step 2. Batch number 2, simplify the numerator. 450 plus 30 is 480 minus 280 leaves 200 million ringgit. So now we have 200 million divided by 140 million. Doing that division gives 1.43. So the answer in the gold box is that the NAV is 1 ringgit and 43 cents per unit. The takeaway restates the golden rule. Always take assets plus other investments minus liabilities, then divide by units. Here, 200 million divided by 140 million gives 1 ringgit 43. Now let us try a slightly trickier two-step question involving a dividend distribution. This second worked example is a two-step question, and it catches many students out, so pay close attention to the order. The question features Puan Aisha, who holds units in a fund with a net asset value of 1 ringgit exactly. The fund then declares a dividend distribution of 12 cents per unit. The question is, how much will she receive if she redeems, that is, cashes in 10,000 units after the distribution has been paid? The trap here is to rush straight to multiplying 10,000 by 1 ringgit. You must not, because the distribution changes the NAV first. So step 1, the NAV falls by the distribution. When a fund pays out a dividend, that cash physically leaves the fund. So each unit is now worth less by exactly the amount paid out. The NAV after the distribution is therefore 1 ringgit minus 12 cents, which equals 88 cents. Think about why the cash has left the fund. So each unit is now worth 12 cents less than before. Only now, in step 2, do we find the redemption value. Puan Aisha redeems 10,000 units, each now worth 88 cents. So the redemption value is 10,000 multiplied by 88 cents, which equals 8,800 ringgit. That is the answer. In the gold box, 8,800 ringgit. The takeaway warns you of the trap. After a distribution, the NAV drops by the payout first. 1 ringgit minus 12 cents gives 88 cents, and only then do you multiply by the units redeemed, giving 8,800 ringgit. With NAV mastered, let us finish the funds half by surveying the full menu of fund types and the fees called loads. Section 6 completes the funds half by giving you the full menu. So far, we have treated mutual funds as one thing, but in reality, they come in many flavors and carry different kinds of sales charges. In this section, we will first learn about loads, which is just the technical word for the sales commission a fund charges. Then we will survey the 12 main types of fund, grouped by what the investor is chasing. And finally, we will meet two close cousins of the mutual fund and the 3 jobs that funds do for investors. Let us start with what you pay, the loads. Before you choose a fund, you must know what you will pay, and the key word is load. A load is simply the technical term for a sales commission charged on a fund, and there are several kinds, shown across the 5 cards. The first is a plain load fund, which charges you a commission at the moment you buy your units. This is called a front-end load because it hits you at the front when you enter. The second is a no-load fund, the friendliest kind, which charges no sales commission at all, so every ringgit you hand over is actually invested. The third is a low-load fund, a middle option that charges a smaller commission, typically around 2 to 3%. The fourth is a back-end load, a clever variation where the commission is charged not when you buy, but when you sell your units, so it waits for you at the exit. And the fifth, the one to watch most carefully, is the hidden or 12B1 charge, an annual fee that quietly recovers commissions in the background, year after year, slowly eroding your returns without you really noticing. The takeaway gives you the practical wisdom. A load is a sales commission. A no-load fund is cheapest upfront, but always watch out for hidden 12B1 charges that erode your returns year after year. Now let us see the full range of fund flavors you can choose from. Mutual funds come in many flavors, and here is the full menu, 12 types grouped into 3 families according to what the investor is chasing. The first family on the left is growth-oriented, for investors who want their capital to grow. A growth fund aims for capital appreciation, rising share prices. An aggressive growth fund goes further, chasing maximum gains but accepting high risk. An equity income fund focuses on shares that pay steady dividends, and a value fund hunts for undervalued, cheap stocks, the bargains we discussed earlier. The second family, in the middle, is income and stability, for investors who want safety and a steady return. A bond fund holds various grades of bonds. A money market fund holds only short-term, very safe instruments, the safest of all. A balanced fund mixes stocks and bonds to balance growth and safety. And a growth and income fund tries to give you both some income and some capital gains. The third family on the right is index and specialty. An index fund simply tracks a market index, our passive friend from earlier. A sector fund concentrates on just one industry, such as technology or healthcare. An international fund invests in foreign securities, and a socially responsible fund screens for ethics and morality, avoiding companies that conflict with certain values, which in Malaysia often means Sharia-compliant funds. The takeaway gives you the guiding principle. Funds range from the ultra-safe money market type all the way to high-risk aggressive growth. So the golden rule is to match the fund's goal to your own goal and your own risk appetite. Finally, let us meet two cousins of the mutual fund and the three jobs funds do for you. To round off the fund's half, let me introduce two close cousins of the mutual fund, and then the three jobs that funds actually do for investors. On the left are two other investment companies that work on the same pooling principle. The first is the REIT, which stands for Real Estate Investment Trust. A REIT is a closed-end company that pools money to invest in real estate and mortgages. So it lets ordinary investors own a slice of shopping malls or office towers through a fund without buying a whole building. The second cousin is the hedge fund, a lightly regulated limited partnership that chases high returns using aggressive strategies and is often high risk and reserved for wealthy investors. So think of these as cousins, not twins. They share the pooling idea but serve different purposes. On the right are the three jobs investors use funds for. The first is as a storehouse of value, simply keeping savings safe and liquid, which a money market fund does well. The second is the accumulation of wealth, growing your money steadily over the long term, which a growth or balanced fund does. And the third is speculation, chasing higher short-term gains, which an aggressive growth or sector fund offers. The takeaway ties it together. REITs and hedge funds are fund cousins, and people use funds to store value, build wealth, or speculate. So the wise investor picks the fund type that fits the particular job. That completes the entire fund's half of our chapter. Now we cross over to the second, more adventurous half, warrants. Welcome to section 7, where we cross into the second half of the chapter and meet a very different kind of instrument, the warrant. If a mutual fund is the safe, sensible, diversified product, the warrant is its adventurous, high-octane opposite, a cheap and geared bet on a single share. Many students find warrants intimidating at first, but I promise that once you grasp the simple idea behind them, everything else follows. In this section, we will define what a warrant is using an everyday analogy, and then meet the two flavors, call warrants and put warrants. Let us begin. So what exactly is a warrant? Let me give you the everyday analogy first, because it makes everything click. Think of a warrant as a reservation. Suppose you cannot afford a house today, but you expect prices to rise. So you pay the developer a small fee now to lock in the right to buy a particular house at today's price at some point in the future. That small reservation fee is what a warrant is like. In the blue box, you pay a little now to lock in the right to buy a share at a set price later without paying the full amount today. Now, the formal definition for your exam. A warrant is like a call option. It gives the holder the right but not the obligation to buy shares directly from a company at a fixed price for a given period. Notice those two crucial words, right but not obligation. You may buy if it suits you, but you are never forced to. Three features define it in the cards. First, it is a reservation, a right, not an obligation, to buy at a fixed price for a set time. Second, it is issued by the company itself, and here is an important distinction. A warrant comes from the company, whereas a very similar instrument, called an option, comes from the exchange. Warrants are often attached to a bond as a sweetener to make the bond more attractive. Third, it has a long life and is cheap. Warrants typically last 5 to 10 years, much longer than options, and they offer a cheap, discounted way to gain exposure to a share. The takeaway, a warrant is the right, not the duty, to buy a company's share at a fixed price before expiry, issued by the company, often as a sweetener. Now, warrants come in two opposite flavors depending on which way you think the price will move. A warrant comes in two opposite types, and which one you choose depends entirely on which way you think the share price is going to move. On the left is the call warrant, and it carries a green bullish tag. A call warrant gives you the right to buy shares from the issuer at a specified price on or before a set date. Crucially, you profit when the share price rises because your warrant lets you buy cheaply at the fixed price while the market price climbs above it. So a call warrant is a bullish bet. You are betting prices will go up. On the right is the put warrant with a red bearish tag, and it is the mirror image. A put warrant gives you the right to sell shares back to the issuer at a specified price on or before a set date. Here you profit when the share price falls because your warrant lets you sell at the high fixed price even though the market has dropped below it. So a put warrant is a bearish bet. You are betting prices will go down. In the gold circle in the middle is versus because the two are genuine opposites. The takeaway summarizes it cleanly. A call is the right to buy and profits when the price rises, a bullish position, while a put is the right to sell and profits when the price falls, a bearish position. And here is a very useful exam tip. The large majority of exam questions use call warrants, so master the call thoroughly. Now, before we can value a warrant, we must learn its vocabulary, the features, which is our next section. Section 8 is a vocabulary section, and it is essential groundwork. You cannot value a warrant until you know the meaning of its parts, just as you cannot cook from a recipe whose ingredients you do not recognize. So in this section, I will walk you through the 8 key features of a warrant, spread over 2 slides. Some of these, like the exercise price and the exercise ratio, will appear directly in the formulas we use later. So learn them well. Let us start with the first 4 features. Before we can value a warrant, we must master its vocabulary, and here are the first 5 key features. The first is the underlying asset, which simply means the share that the warrant is issued on. For example, a particular company's stock. Everything about the warrant depends on this underlying share. The second, and one of the most important, is the exercise price, also called the strike price. This is the fixed price at which you may buy the share if it is a call, or sell it if it is a put. Note that it is usually set 10 to 20% above the current market price when the warrant is issued. Third is the expiration date, the last day on which the warrant can be exercised, after which it becomes completely worthless, and warrant lifespans are often quite long, 5 to 10 years. Fourth is the mother share price, which is just a name for the current market price of the underlying share on which the warrant is based. You will sometimes see it called the mother share. And the fifth feature is effective gearing, the heart of why warrants are exciting and dangerous. Gearing tells you how much more exposure you get from the warrant compared to simply buying the share. If the gearing is 5 times, then a 1% move in the share produces roughly a 5% move in the warrant. The takeaway flags the two to remember most. The exercise price is the locked-in buy or sell price, often set above the market, and gearing is the magnifier that multiplies both your gains and, just as importantly, your losses. Let us continue with the remaining features. Here are the remaining 4 features of a warrant, completing your vocabulary. The first is the distinction between detachable and non-detachable. Remember that warrants are often attached to a bond as a sweetener. A detachable warrant can be separated and sold on its own, independently of the bond it came with, which gives you flexibility. A non-detachable warrant cannot be separated. It lives and dies with its bond. The second feature is the warrant premium, and this is an important one we will calculate later. The premium is the extra cost of buying a share through the warrant compared to simply buying it in the open market. It is the price of the convenience and the hope the warrant offers. The rule to remember is that the lower the premium, the cheaper, and therefore the more attractive the warrant is. The third feature, and one that appears directly in our formulas, is the conversion or exercise ratio, written ER. This is the number of shares you receive for each warrant, or sometimes the number of warrants needed per share. For example, a ratio of 4 to 1 means you need 4 warrants to buy 1 share. Watch this carefully in calculations because it scales the intrinsic value. The fourth feature is settlement, which is simply what the holder actually receives when they exercise the warrant, and it can be settled either in cash or in shares, depending on the terms. The takeaway highlights the two that matter most for calculations. The exercise ratio is the number of shares per warrant, and it appears in the intrinsic value formula. And a low premium means the warrant is relatively cheap. Now that you have the vocabulary, let us weigh the pros and cons of warrants before we value them. Section 9 weighs warrants on honest scales, just as we did for funds, but this time from 2 different chairs. First, we sit in the investor's chair and ask, what do I gain and what do I risk by buying a warrant? Then we move to the company's boardroom and ask, why would a company issue warrants in the first place? And what are the strings attached? Seeing both perspectives will give you a complete, balanced understanding before we move to the valuation maths. Let us start with the investor. Let us sit in the investor's chair and weigh warrants honestly. The advantages on one side, the risks on the other. Starting with the advantages on the left. First, many warrants are detachable, meaning you can sell the warrant separately from the bond it came attached to, giving you flexibility. Second, there is the chance of a capital gain. If you exercise at the right time as the share price rises, you profit handsomely. Third, your status is unchanged. If your warrant came with a bond, you remain a bondholder, still entitled to your interest and principal. And fourth, the great attraction, warrants are cheap and geared. A small outlay gives you magnified exposure to the share. The very thing that lets you turn 1,000 ringgit into 5,000 ringgit of exposure, as our opening question promised. But now the risks on the right, and these are genuine. First, a warrant carries no shareholder rights. You have no vote, you receive no dividend, and you have no claim on the company's assets. You are merely holding a right to buy. Second, every warrant has an expiry date, and if the share price has not moved your way by then, the warrant can expire completely worthless. you lose your whole stake. Third, warrants are high risk and highly volatile. Their prices swing sharply up and down. And fourth, the sting in the tail. Gearing cuts both ways. The same leverage that magnifies your gains will magnify your losses just as fiercely. The takeaway is balanced and important. Warrants offer cheap, geared upside and stay detachable, but they carry no shareholder rights, they expire, and they are highly volatile, the classic profile of high risk and high reward. Now let us briefly see why a company would issue warrants in the first place. Now let us switch chairs and look at warrants from the company's point of view, because understanding why a company gives them away completes the picture. On the left are the advantages for the issuer. First and foremost, a warrant is a sweetener. By attaching a warrant to a bond, the company makes the bond more attractive to investors, which raises demand for the bond and ultimately means more profit and easier fundraising. Second, warrants bring extra cash flow because when investors eventually exercise their warrants, they pay the exercise price to the company, handing it fresh cash. And third, issuing warrants is a low-cost way of financing, cheaper than many alternatives, but there are disadvantages too on the right. First, investor perception. The very act of needing a sweetener might signal to the market that the bond or the company is weaker and needs help to sell, although in some cases it can signal the opposite. Second, the obligations continue. Attaching a warrant does not reduce the company's duty to keep paying the bond's fixed interest and to repay its principal promptly. And third, the big one, dilution risk. When warrant holders exercise, the company must issue brand new shares to them, and those new shares dilute the ownership stake of the existing shareholders, shrinking everyone's slice of the pie. The takeaway balances both sides. Companies issue warrants as a cheap sweetener that brings in extra cash, but it can dent market perception, and they still owe the bond's interest and principal regardless. Now we arrive at the climax of the chapter, actually valuing a warrant with 4 formulas and full worked sums. We have reached section 10, the climax of the whole chapter and the part the exam loves most. Here we learn to put a number on a warrant. A warrant's market price is built from 2 ingredients: what it is worth if you exercised it right now, and an extra amount investors pay for future hope. We will meet 4 formulas: the intrinsic value, the warrant premium, the gearing, and the conversion premium, and then work through 2 complete exam-style examples featuring Mr. Adim and a percentage premium question. Keep your calculator ready. This is the heart of LO3. Before we crunch any numbers, let us understand what actually gives a warrant its value, because every warrant's market price is built from 2 ingredients, and once you see them, the formulas make complete sense. As the blue box says, a warrant's market price equals its intrinsic value, what it would be worth if you exercised it right now, plus a speculative premium, an extra amount investors are willing to pay for the hope of future gains. Let us take each ingredient. On the left is the intrinsic value, also called the theoretical or minimum value. This is simply what the warrant is worth if you converted it to shares right now, today. For a call warrant, it equals the market price of the share minus the exercise price, all multiplied by the exercise ratio. The crucial rule to burn into your memory is that the intrinsic value can be 0, but it can never be negative. Because nobody is forced to exercise a warrant at a loss, you would simply walk away. On the right is the speculative premium, the price of hope. This is the extra amount investors will pay above the intrinsic value in exchange for the hope that the share price will rise further before expiry. It reflects how much time is left until expiry and how volatile the share is. More time and more volatility mean more hope. and therefore a bigger premium. And this premium is precisely why a warrant's market price is almost always greater than its bare intrinsic value. The takeaway: the warrant's market price equals intrinsic value plus speculative premium. The intrinsic value can be zero but never negative, and the premium is the price of hope. Now let us turn each of these ideas into a formula, starting with the intrinsic value. Here is the first and most important warrant formula: the intrinsic value, also called the theoretical value, for a call warrant. It tells you what the warrant is worth if you exercised it today. The formula is intrinsic value equals, in brackets, the market price of the share minus the exercise price, all multiplied by the exercise ratio. Let me define each symbol in the navy box. I4 is the intrinsic or theoretical value we are solving for. MP sub Cs is the market price of the underlying share. EP is the exercise price, the fixed price you may buy at. And ER is the exercise ratio, the number of shares per warrant. Now, there is one absolutely critical rule shown in the gold box. This formula only applies when the warrant is in the money, meaning the share price is above the exercise price, MP greater than EP, because only then is it worth exercising. If instead the exercise price is above the share price, the warrant is out of the money and its intrinsic value is simply zero, never a negative number, because you would just choose not to exercise. Let me show you the quick sum at the bottom. Suppose the share's market price is 8 ringgit, the exercise price is 3 ringgit, and the exercise ratio is 1. Then the intrinsic value is 8 minus 3, which is 5, multiplied by 1, giving 5 ringgit. So this warrant is worth 5 ringgit if exercised today. The takeaway: the call intrinsic value equals the share price minus the exercise price times the exercise ratio, but only when that is positive, in the money, otherwise the intrinsic value is zero. Next, the warrant premium. The second formula is the warrant premium, which measures the extra cost of buying a share through the warrant compared to buying it directly in the open market. In other words, the price of the hope and the time value built into the warrant. It can be expressed two ways. In ringgit, on the left, the warrant premium, written W sub PM, equals the market price of the warrant, MP sub W, minus the intrinsic value IV. So it is simply how much more the warrant costs than its bare intrinsic worth. In percentage terms, on the right, you take that same gap, the market price of the warrant minus the intrinsic value, and divide it by the intrinsic value, then multiply by 100. Let me work the sum at the bottom. Suppose the warrant trades at 7 ringgit and its intrinsic value is 5 ringgit. In ringgit, the premium is 7 minus 5, which equals 2 ringgit. That is the extra you are paying for hope. In percentage, it is 7 minus 5, which is 2 divided by the intrinsic value of 5, giving 0.4 times 100 equals 40%. So you are paying a 40% premium over the warrant's intrinsic value. The takeaway: the warrant premium is the market price of the warrant minus its intrinsic value in ringgit, or that same gap divided by intrinsic value as a percentage. And remember the rule: a lower premium means a relatively cheaper, more attractive warrant. Next, the formula that captures the excitement of warrants, the gearing. The third formula is gearing, also called leverage. And this is the number that captures why warrants are both thrilling and dangerous. Gearing measures how much more exposure you get from holding the warrant compared to simply buying the share outright. The formula is gearing G equals the market price of the share, MP sub CS, divided by the market price of the warrant, MP sub W, all multiplied by the exercise ratio. The symbols are in the navy box. G is the gearing in times, MP sub CS is the share price, MP sub W is the warrant price, and ER is the exercise ratio. Let me work the sum. Suppose the share trades at 8 ringgit, the warrant at 7 ringgit, and the exercise ratio is 1. Then the gearing is 8 divided by 7, which is about 1.14 times 1, giving 1.14 times. And here is what that actually means. Shown on the right, a 1% move in the share price produces roughly a 1.14% move in the warrant. In this example, the gearing is modest, but warrants often have gearing of 5 or even 10 times. The higher the gearing, the higher your potential gain. But, and this is the warning, also the higher your potential loss, because gearing magnifies movements in both directions equally. The takeaway, gearing equals the share price divided by the warrant price times the exercise ratio, and it measures leverage. Higher gearing magnifies both your gains and your losses on every share price move. Our fourth and final formula expresses the premium against the share price, the conversion premium. Our fourth and final warrant formula is the conversion premium, which is a close relative of the warrant premium we met earlier, but with one important difference in the denominator. So watch carefully. The conversion premium, written CP, equals the market price of the warrant minus the intrinsic value, divided by the market price of the share, all times 100 to make it a percentage. Notice the symbols in the navy box. CP is the conversion premium as a percentage. MP sub W is the warrant price. IV is the intrinsic value. And MP sub CS is the share price. Now here is the key thing to notice, and it is a favorite exam trap. The numerator, the top, is exactly the same as the warrant premium, the warrant price minus the intrinsic value, but the denominator, the bottom, is different. The ordinary warrant premium divides by the intrinsic value, whereas the conversion premium divides by the share price. Same top, different bottom. Let me do the sum. Suppose the warrant price is 2 ringgit, the intrinsic value is 1 ringgit 30, and the share price is 3 ringgit 80. Then the conversion premium is 2 minus 1.30, which is 0.7, divided by 3.80 times 100, giving 18.42%. The takeaway, the conversion premium equals the warrant price minus the intrinsic value, divided by the share price. As a percentage, it is just like the warrant premium, but divided by the share price, not the intrinsic value. With all four formulas in hand, let us now put them to work in two full exam-style worked examples. Let us put the formulas to work in a complete exam-style example featuring Mr. Adim. He owns a warrant of highest Berhad. The warrant lets him buy one share at 3 ringgit, so the exercise price is 3 ringgit, and each warrant converts to 1 share, so the exercise ratio is 1. The warrant currently sells for 7 ringgit, and the share's market price is 8 ringgit. We are asked 3 things. Should he exercise? What is the theoretical value? And what is the warrant premium? Part A, should he exercise? We compare the market price of the share to the exercise price. The share is worth 8 ringgit in the market, but his warrant lets him buy it for just 3 ringgit. Since the market price of 8 is greater than the exercise price of 3, the answer is a clear yes, he should exercise, because he can buy at 3 a share worth 8, an obvious bargain. Part B, the theoretical or intrinsic value. Using Formula 1, intrinsic value equals the share price minus the exercise price times the exercise ratio, so that is 8 minus 3, which is 5, times 1, giving 5 ringgit. So the warrant is worth 5 ringgit if exercised today. Part C, the warrant premium. Using Formula 2 in ringgit, The premium equals the market price of the warrant minus its intrinsic value, that is 7 minus 5, which equals 2 ringgit. The takeaway sums it up: exercise when the market price exceeds the exercise price. Here, the intrinsic value is 8 minus 3 times 1, which is 5 ringgit, and the premium is 7 minus 5, which is 2 ringgit, the price Mr. Edim pays for the time and the hope remaining in the warrant. Now, a slightly harder example, focusing on the 2% premiums. Our final worked example pulls together 3 calculations in one question, and its whole purpose is to drill the difference between the 2% premiums, which is the most common exam trap in this topic. The question: a stock's market price is 3 ringgit 80, written MP sub Cs. A warrant trades at 2 ringgit MP sub W and entitles you to buy one share at an exercise price of 2 ringgit 50 with an exercise ratio of 1. We must calculate 3 things. Part A, the intrinsic value. Using formula 1, it is the share price minus the exercise price times the ratio, so 3.80 minus 2.50, which is 1.30 times 1, giving 1 ringgit 30. Part B, the market premium as a percentage. Using formula 2, we take the warrant price minus the intrinsic value, 2 minus 1.3, which is 0.7, and divide by the intrinsic value of 1.3, then times 100, giving 53.85%. Part C, the conversion premium as a percentage. The numerator is exactly the same, 2 minus 1.3, which is 0.7. But now, and this is the crucial difference, we divide by the share price of 3.80, not the intrinsic value. That gives 18.42%. Look how different the two answers are. 53.85% versus 18.42%, even though the top of each fraction was identical. The takeaway shouts the lesson. Watch the denominator. The market premium divides by the intrinsic value, giving 53.85%, while the conversion premium divides by the share price, giving 18.42%. Same numerator, different bottom. Master that distinction and you will not lose marks. That completes all our calculations. Let us now pull the whole chapter together. Now, let us consolidate the whole chapter into a single comparison table you can use for revision, matching each instrument to its goal, its risk, its cost, and who it best suits. Read down the rows, because they are deliberately arranged from safest at the top to riskiest at the bottom. The money market fund aims for safety and liquidity with very low risk and low cost, ideal for parking cash short term. The index or passive fund aims simply to match the market, carries ordinary market level risk, has very low fees, and suits the long-term hands-off saver. The active equity fund aims to beat the benchmark, but carries higher risk and higher fees, and only suits those who genuinely believe in their manager's skill. The closed-end fund offers traded exposure with the added quirk that its price can differ from its NAV at low to moderate cost, suiting investors who want to trade their units on the market. Then come the 2 warrants, highlighted in gold. The call warrant is a geared bet that the price will rise, high risk but cheap and geared, suiting a bullish, risk-tolerant investor. And the put warrant is the mirror, a geared bet that the price will fall, equally high risk, suiting a bearish, risk-tolerant investor. The pattern, captured in the remember box, is that as risk rises from top to bottom, so does the potential return. Funds are diversified and managed, while warrants are concentrated, geared bets. So as always, you pick the instrument that fits your own goal. Let us see this play out in a real allocation decision. Let us bring the whole chapter to life with a realistic allocation decision, where local and global forces meet a real money choice. The scenario: Puan Aisha, aged 35, has 30,000 ringgit to invest for her retirement. The economic backdrop: the United States Federal Reserve has just signaled interest rate cuts, which has lifted both the American and P500 and our own FBM KLCI, a hopeful, bullish moment. Her advisor must decide how to split the 30,000 between three options: topping up her EPF, buying an index fund, and taking a few Bursa call warrants. Watch how the advisor thinks in 3 steps. Step 1. Assess her goal and risk. Retirement is a long horizon, decades away. But crucially, she has a low tolerance for big losses because this is her future security. Step 2. Choose the call. The bulk of the money goes into a low-cost index fund and an EPF top-up, both diversified and passive, safe, steady, and cheap. This is the foundation. Step 3. Add a small satellite. A tiny slice, only money she can genuinely afford to lose, goes into call warrants, giving her some geared upside to benefit from the bullish market without risking her call. The manager's insight in the dark box is the lesson of the whole chapter. Smart allocation means a big, diversified, passive core of funds and EPF plus a small, geared satellite of warrants, sized so that even a total loss of the satellite would not hurt her. That is how a professional balances safety and opportunity. Let us finish with a one-page revision map. Here is the whole chapter on a single page, your revision map with funds on the left and warrants on the right, two halves joined by one logic. At the top sits the subject, Chapter 9, Funds and Warrants. Everything flows down into two columns. On the left, the mutual funds half with its 6 ideas in order. First, the concept and pool diversification. Second, active versus passive management. Third, the pros and cons of funds. Fourth, the structure with its 4 players and the open versus closed distinction. Fifth, the NAV maths covering NAV per unit and redemption. And sixth, the fund types and loads. On the right, the warrants half, also 6 ideas. First, what a warrant is and the call versus put distinction. Second, the features, the exercise price, exercise ratio, gearing, and premium. Third, the pros and cons for both investors and issuers. Fourth, the idea that a warrant's value equals intrinsic value plus premium. Fifth, the 4 formulas: intrinsic value, premium, gearing, and conversion premium. And sixth, the worked examples. And along the bottom, in gold, is your exam survival kit. The 6 calculations you must be able to do by hand: NAV, redemption, intrinsic value, premium, gearing, and conversion premium. If you can explain both columns and perform those 6 sums, you have mastered this chapter. Let me close with a final word. And that brings us to the end of Chapter 9 on mutual funds and warrants. You have come a long way. You started perhaps thinking a unit trust and a warrant were mysterious, and now you understand both. You can weigh their advantages and risks, and most importantly, you can perform every key calculation. Questions are very welcome, and this is exactly the time to ask them. So please do bring me anything that is still unclear. Before you sit the exam, make sure you can do all 6 of these calculations by hand without notes, listed in the box. First, the NAV per unit and the redemption value of a fund. Second, the intrinsic value of a call warrant. Third, the warrant premium in both ringgit and percentage form. Fourth, the gearing or leverage. Fifth, the conversion premium as a percentage. And sixth, the decision of when to exercise a warrant by comparing the market price to the exercise price. Practice these until they are automatic, ideally by redoing the 4 worked examples without looking at the solutions, and by paying special attention to the 2 traps we met, dropping the NAV by the distribution before redeeming, and watching the denominator when choosing between the market premium and the conversion premium. If you can do all of that, you are ready, not just for the exam, but to make smart, balanced investment decisions in real life. Thank you so much for your attention throughout this chapter. Take care, and I will see you in the next one.